Friday, June 30th, 2017, Monaco 64, home of alternative economics and contrarian views. So I'll be looking at the bond market today, and there's a lot being written about and talked about the bond market in the last few days. As many of you probably know, I worked in the city, in the financial markets, and my area of expertise is the bond market. I started out in Switzerland for a small fund manager, private banker firm. Even before I started the job, I did an internship in London at a bond trading company. So I know a lot about cash bonds, the cash bond market and the derivatives bond markets. So right now, there's a lot in the news. I even bought the FT this morning. Usually I don't. The FT now is £2.70. I remember about 12 years ago when I used to buy it every morning. It was 70 pence. And it was a lot thicker than it is now. I'll let you know. I think it was twice the size, and now it's £2.70. Here's the price if you don't believe it. £2.70. But the reason I bought it though is because of this headline. It says, global bond rout spills into stocks amid fears over end to easy money. So there you go. That's the FT. The thing that is kind of a bad signal or bad omen, or an omen, you don't have to call it a bad omen, is that usually when you see in the past 10-15 years, when stocks dump or correct down, global bonds actually do well because they're considered a flight to safety. But today, yesterday and the last few days, as they're both been going down together, bonds and stocks. So that's unusual. And the reason why I want to talk about this is because I think the central bankers are testing the waters. Right now, they're just talking about reining in, what they've done in the last 10 years, all the QE, all the government bond buying, all the comments they've made, especially Mario Draghi back in 2012. Many people, only talk about the 2008 crisis, but 2010 to 2012, that was another big crisis that would have affected the whole financial system, the European sovereign bond crisis. So this is what the FT says. I'll just read a little bit over their comments. It says, central banks' remarks spark sell-off. Euro First and S&P 500 equities indices decline. And it goes on to say, a global sell-off in the bond market spread to equities yesterday amid fears that the post-crisis era of easy money from the world's largest central banks was coming to an end. While bond yields remain exceptionally low, recent remarks by the heads of the European Central Bank, the Federal Reserve, the Bank of England, and the Bank of Canada have convinced many investors the period of historically low interest rates and unprecedented central bank bond buying will soon recede. So yeah, the FT does remark that, the moves yesterday were, quite, despite the moves yesterday, rates remain exceptionally low. And I agree with them on that. And that's why I'm going to, in a minute or so, I'll be looking at some charts. I think it's always interesting to look at charts, short-term, longer-term charts, to see where we are, to see whether it's necessary to panic or be concerned. At the moment, I don't think there's reason to panic. The markets still seem to be under control. But another point I'd like to make, the fact that the heads of these major central banks that have all come out and said the same thing, just goes to show that it's a banking cartel, it's a monopoly. Why should they be working together? What does the Bank of Canada should be worried about Canada? Not the other countries, but they do work together because it's a club. You know, they help each other out to keep, you know, the bond bubble going. So yeah, the question now is whether, you know, these the central bankers, they've created a massive bond bubble. That's the gist of it. And now they're trying to unwind. Will they be able to unwind the biggest bubble ever in the financial, you know, in recorded financial history? That not a very good chance, I would say. So that's why I want to look at the chart, so you can see why, you know, this is a huge bubble. And the first chart I want to show you is U.S. 10-year Treasury yields since 1790. You know, I'm not sure so the U.S. government has been borrowing money since then, you know, after the Revolutionary War, had a huge debt. So here's the chart. Excuse me. You know, after the Revolutionary War, the War of Independence, yields never got back up, never went up to 9. And then they've, you know, in the 19th century up until, you know, the beginning of the 20th century, the trend was down. But I would say, you know, that the average yield going all the way, you know, to like 1920 would have been like 4 to 5% for the U.S. government, maybe a little higher, 5%. And then you have that drop there, you know, from the Great Depression to the end of World War II. I think we bought them pretty much where we bought them last year, around 1.3%. And after that, after World War II, yields started going up, and they accelerated even more after the U.S. went off the gold standard in 1971. And you can see the 10-year yield actually spiked all the way up above 15% in like the early 1980, I think 1980, 1981. There, you know, people had lost faith in the dollar because it wasn't, you know, backed by gold anymore. You know, prices were rising quickly. And then Volcker came in and let the short-term rate rise to like over 20%. And that killed the bond bear market. And ever since then, look, you know, this has been, you know, the biggest bubble, bond price bubble ever, really. We've gone from, you know, above 15% to a low of 1.3. Bond prices have always kept going up. And that's despite all the U.S. going from having $1 trillion in debt in 1980 to having $20 trillion right now. I think in 1980 it was about 35–40% of GDP. I'm not sure, but it was a lot less proportionally than now. And you might ask, how can, you know, bond yields go down when the debt's going up? Well, I personally think one of the reasons is Paul Volcker. He gave the dollar credibility by doing what he did in 1980. So the dollar and the bond market is riding a little bit on the back of Paul Volcker's, you know, efforts. You know, they're resting on its laurels, so to speak. The other reason, I think, is the derivatives market. Futures, over-the-counter derivatives, swaps, which is part of derivatives. Before the mid-80s, there were the only kind of derivative markets were mainly commodity and also a bit foreign exchange, which started in the mid-70s. But there wasn't a government or a bond market derivatives for bond markets. There weren't futures for bonds. And then they started trading the long bond future, and then the 10-year future, and what that's done. And then also over the counter, because futures are usually traded on an exchange, over the counter, you know, swaps, all kinds of instruments. And what that's done, just like in the gold market, paper gold market, like the futures and the over-the-counter derivatives on the LBMA, that's allowed the big players and the authorities, you know, monetary authorities, to keep the markets under control with derivatives, because derivatives are like, you know, it's like a bucket shop. You bet on the price, but you're not actually betting on the security. And the other thing it's done to investors, it's given them a sense of complacency, because they might be have a huge position in treasuries or mortgage-backed securities. But if they're able to hedge it doing the futures or swaps, they don't feel as concerned about, you know, maybe the price going down as yields go up, because oh, we can hedge ourselves. So I think the derivatives, and also Glass-Steagall in 1999 with the abolition of Glass-Steagall, that's allowed all the commercial banks to be involved in the derivatives. So they've been able to put a lot more money behind it. Before that, it was only the investment banks, and they had to risk their own capital in this derivatives market. So it's become, you know, that's why I think we've had this bond bubble. First, Paul Volcker gave back credibility to bonds by being really hawkish in 1980, letting rates go up to 20%, short-term rates. What else? The creation of bond derivatives, be them over-the-counter or exchange-traded, and also the repeal of Glass-Steagall. And a few years ago, I think 2014 as well, there's not a law that went into effect. I think it was during almost at Christmas or New Year, that allows U.S. commercial, you know, the big commercial banks or investment banks, that they're all together the same now. It allows them to insure their derivatives exposure with the FDIC, which is supposed to insure bank deposits. So that's also helped keep this Ponzi going. So I wanted to show you that chart first, and now I want to show you what's happened in the last few days to U.S. Treasury yields, the 10-year yield, just so you can have an idea. So we're still around 2%, just above 2%. So as you can see, we've gone from just below 215, and we're now around 227. So yeah, it was, relatively speaking, that's a big move in a week. You know, 12 basis points. I think this morning is at around 229, so it's kept going up. But it is a little bit, if you can see in the last month, it's a big move. But as you can see, it's still, you know, in the 2 range, not 10 or 15% yield. Then I'll have a look here at a 10-year chart going back to 2013. This is where I'll give you the levels you need to keep an eye on. The really key levels here, you can see there's like a double top beginning of this year, end of last year, and that's just around, just above 2.6%. I think 2.63 is the key level. And once if we do break above that, then yeah, I will be, you know, looking a lot closer at the bond market. If we don't, business as usual. And in 2014 there, that top just in the beginning of that year was 3%. So those are the key levels, 2.63 and 3%. And that's still very short term. What we need to keep an eye on is if we start moving 20 to 15 to 30 basis points a day higher, then we know there's a problem. So now I'm going to look at the Italian government bond yields. Because, and I'll play this little clip here. 2012 in July, Mario Draghi, when the whole, you know, euro project was under threat because of the government bond crisis in Europe, sovereign bond crisis, when yields were spiking higher for the pigs, so to speak, Portugal, Italy, you know, Ireland, Greece, and Spain. He came out with this comment, and this was July 26, 2012 at UKTI Global Investment Conference, and that's what he said, and that's what calmed the markets down.
There's another message that I want to tell you today, is that within our mandate, the ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
So yeah, that's when, you know, basically the sovereign government bond crisis ended in Europe. But I'll show you just to have an idea of why I'm doing this video and why I'm saying, you know, don't be alarmed yet. We're still a long way away. So this is the Italian government bond yield going back to 1807. And you can see the Italians have been profligate. I would say their average rate is probably around north of 7%. It's only been, you know, since, you know, they've decided to join the euro, you know, when they had the convergence started in the mid-90s, you know, that yields have really dropped. You can see that, you can see the spike here in 2012, and then the drop lower. That was, you know, after Draghi made that speech. So the other interesting chart I want to show you is the spread between the Spanish 10-year bond and the German 10-year bond. And this will show you what the crisis in Europe was all about. You know, it would have been nice to find just a Spanish 10-year yield chart, but I couldn't. I got the spread, which is basically pretty much the same thing. It just goes to show you how much quicker Spanish 10-year yield went up versus the German 10-year. And you can see here in the chart, you know, when they started talking about convergence, you know, and creation of the euro, that yield dropped from 4 almost to nothing in 1998. You know, it was a positive yield, but almost near zero, because now people believed, you know, as the Spanish government bond was in euros, there wasn't much risk, so they priced it almost like a German Bund. But you can see here, after the crisis in 08 starts going up. In 09 it went up above 1%, and then it dropped. But then it started in 2010. And I was in the markets back then. And they were wild days. You could just see these yields going up. And you can see there that the spread went up above 6%. I think at the time, German yields were probably 1.5 or 2. So we got up to like 8%, almost 10% in the Spanish yield. And then you can see that spread drops dramatically, you know. And that's right in the middle of 2012 when Draghi made that speech. So I can tell you right now where the spread is. I've got the bond prices here. So Spanish 10-year right now is 1.54. The German is 1.47. So the yield is just above 1%. So that's why I'm doing this video. Yes, we've had a little bit of a bond sell-off, but things are still under control. You know, I don't like to make alarmist videos. All we need to do is keep an eye on this, see if it evolves more, or if this was just a little, you know, like flash in the pan and nothing's going to happen after that. But it's important, and it's the most important signal for financial markets, the bond yield. So if you enjoyed this video, give me a thumbs up. Share it far and wide, and also if you haven't subscribed yet to my channel, please do. And if you want to watch me on Steemit, follow me there as well. It's steemit.com. Steemit is like a social media website or a platform based on the blockchain where creators, viewers, everyone can earn cryptocurrency. So I'll talk to you later. Bye.